The 2008 Financial Crisis, an epic Episode 1, The Perfect Storm. September 16, 2008. A money market fund breaks the buck. Phones light up, credit freezes, the world holds its breath. How did sleepy mortgages turn into global cardiac arrest? In the next minutes, we trace the wiring. Who pulled which levers, what failed, and why the system behaved exactly as designed, only worse. You'll hear a simple map of a complicated machine. Cheap money, a housing boom, a factory that mass-produced risk, and rules that quietly invited catastrophe. We'll name names, decode the jargon, and end with what changed and what did not. First, a new age of risk. In 1999, the wall between deposit banks and investment banks came down. In 2000, a law left most over-the-counter derivatives, like credit default swaps, outside strict oversight. In 2004, a change at the securities regulator let big broker-dealers rely on internal models and take far more leverage. International rules called Basel II leaned on credit ratings and encouraged capital arbitrage. The shared belief was simple: markets self-correct. Sophisticated firms can police themselves. The result was shadow banking as large as traditional banking, investment banks, money market funds, structured vehicles, and the repo market, with much thinner safety rails. Next, the house that roared. After the dot-com bust on September 11th, the central bank cut rates to historic lows. Cheap dollars plus a global glut of savings-hunting yield poured into U.S. housing. Prices detached from incomes. Speculation bloomed: buy, flip, repeat. Global capital craved safe yield, and Wall Street manufactured assets to feed the appetite. A teaser rate mortgage, the 228 ARM, meant low rate now and much higher later. It sold dreams today and detonated tomorrow. Then the subprime machine. To feed demand, lenders dropped standards.
Yes!
No income,
Get me
no
100
job,
shares.
no assets.
Buy.
Step right up. The model shifted to originate to distribute, make the loan, collect the fee, pass the risk along. Loans were pooled into bonds called MBS, mortgage-backed securities. The riskier slices of those were pooled again into CDO, collateralized debt obligations. The factory ran hot because fees were juicy at every stage. A tranche is a slice of cash flows. Senior slices get paid first. Equity slices eat losses first. And now, Wall Street alchemy. By stacking loans into tranches, bankers could claim most of a CDO was ultra-safe AAA, even when the ingredients were weak. Popular models, like a Gaussian copula for default correlation, assumed house prices across regions would not fall together. When correlation spiked, the math collapsed. Off-balance sheet vehicles and conduits parked risky assets away from view, funded with short-term commercial paper. It worked until short-term lenders got scared. Correlation is how often bad things happen together, low in the brochure, high in real life. Episode 2, The House of Cards. First, the stamp of approval. Credit rating agencies, Moody's, S&P, and Fitch, were gatekeepers to global money. Issuers paid them, and competition drifted toward rating shopping. Mountains of mortgage bonds and structured products wore AAA badges that later fell to junk. Pension funds, insurers, and banks bought them because rules said AAA meant a safe. The rules were wrong. Next, the biggest insurance bet. Enter CDS, credit default swaps, contracts that pay if a bond fails. Unlike traditional insurance, sellers did not have to hold classic reserves. You could even buy protection without owning the bond. Side bets stacked on the same risk. One CDO, many CDS, multiplied losses. The largest seller on mortgage products was the Financial Products Unit of AIG, a giant insurer. Fees looked like free money. The belief was that a national fall in house prices was nearly impossible. Then the watchman asleep. Regulators had tools, but not the will. Warning signs were visible: predatory lending and exploding subprime volumes. Supervisors were fragmented, and firms could shop for the friendliest overseer. The idea that market self-discipline met the reality that bonuses paid on volume discipline nothing. By year-end, the U.S. was in recession. The virus found the bloodstream, wholesale funding, and derivatives. A modern bank run is a run on repo. Short-term lenders roll yesterday's cash until the day they don't. Episode 3, The Collapse, the longest weekend. Lehman Brothers bled cash. Officials pushed for a private buyer. A quick deal fell apart. No government backstop. Lehman filed. Dominoes fell. September 15th, the biggest bankruptcy in U.S. history. Stocks plunged, but the real terror was invisible. Interbank lending seized. Repo haircuts jumped. Commercial paper dried up. The abyss. September 16th, AIG, the giant insurer that sold default swaps, could not meet collateral calls. Because it was the counterparty to everyone, its failure would trigger a global chain reaction. The central bank stepped in with an emergency credit line and took control. Policy now looked inconsistent. Lehman failed. The insurer was rescued. Confidence kept dropping. Global scale panic. Money market funds faced a stampede after the reserve primary fund broke the buck. Corporations worried about making payroll. Spreads like the TED spread and the LIBOR to OIS spread exploded. Those were thermometers of fear. Central banks cut rates together and unleashed liquidity facilities. The patient was still in shock. To break the buck means a $1 money fund cannot return a full dollar per share. That is panic with paperwork. Episode 4, The Aftermath. First, the wall of money. The Treasury asked Congress for an extraordinary tool, TARP, authorized at $700 billion. The plan shifted from buying toxic assets to injecting capital directly into banks. The central bank launched QE, buying treasuries and mortgage bonds, and opened a zoo of facilities to unfreeze funding markets. Fannie Mae and Freddie Mac went into conservatorship. In 2009, stress tests called SCAP forced the biggest banks to raise capital or accept it. Next, Main Street versus Wall Street. Banks got lifelines. Millions of households got foreclosure notices. Roughly 4 million families lost homes. About $11 trillion in household wealth evaporated. Behind each number stood a borrower whose teaser rate jumped, a small business that lost its credit line, a neighborhood dotted with for sale signs. Then, the Great Recession. Real output fell about 4.3%. Unemployment doubled and peaked near 10%. The S&P 500 dropped 57% from its high. Trade contracted worldwide. On paper, the recession ended in mid-2009, but the recovery was slow and uneven. Inequality widened. Episode 5, Reckoning, a new rulebook. Dodd-Frank in 2010 rewired parts of the system. The Volcker Rule curbed proprietary trading at deposit-taking banks. A new consumer bureau targeted abusive lending. The biggest banks had to file living wills, hold more and better capital, and meet liquidity ratios like LCR and NSFR. Many derivatives moved to central clearing with margin.
What?
We are the 99%. Public fury over bailouts and impunity fueled Occupy Wall Street. The slogan landed because The crisis exposed a structural reality. Gains privatized, losses socialized. On the right, the Tea Party channeled a different anger about government power. Two currents, one wellspring, broken trust, lessons not fully learned. Safer in many ways, yes. But the largest banks are even larger and more connected. The shadow system, private credit funds, dealer repo, basis trades, still moves oceans of risk outside the brightest spotlights. Rating incentives and model myopia never vanish. They mutate, myth and fact. Saving Lehman would have saved the day. Myth. It might have softened the blow, but housing losses, thin capital, and fragile funding were already systemic. Markets always self-correct, Plin. CDS are just insurance. Half true. Without traditional reserves and with side bets allowed, they amplified losses beyond the bonds themselves. It was all subprime number. Prime mortgages, Alt-A, leveraged loans, and short-term funding all joined the pileup. The present rhyme. In 2023, several U.S. banks failed for a different reason. Rates rose fast. Long-duration bonds lost value. Uninsured deposits ran at social media speed. New capital and liquidity rules helped contain the damage. But the lesson echoes 2008. When confidence turns, funding fragility moves faster than policy. Closing. Did we fix the machine? We strengthened parts. We labeled a few levers. We added airbags. But complexity, incentives, and the dream of painless yield are stubborn. History does not repeat. It samples its own beats. Next time we walk through the securitization factory, step by step, from mortgages to bonds to structured products, and why the math did not save us. Definitions for quick drops. MBS, a bond backed by thousands of mortgages. You get paid when homeowners pay. CDO, a bundle of risky slices from many bonds. Re-sliced to look safer. CDS, pay a fee and get paid if a bond defaults, often without owning the bond. Tranche, a priority slice of cash flows. Senior first, equity last. Shadow banking. Bank-like funding without bank-like rules, including repos, SIV, and money funds. Repo market, overnight secured loans. If lenders demand bigger haircuts, funding vanishes. SIV and ABCP, off-balance sheet vehicles funding long assets with short paper. Basel II, risk-based capital rules that leaned heavily on ratings and models. SCAP and QE, 2009 stress tests, and central bank bond buying to unfreeze markets.